So we know as much from the Fed. What does a person like you that devised this portfolio strategy do with all that information that came out these last few hours?
Yeah, I think that at a high level, we're encouraged by some of the statements that Chairman Powell made. I think particularly the use of the word nimble and humble. I think that's something that stood out in our minds because that tells us that there is something in the price in the market, which is something like, as Catherine was saying, 3 to 4 hikes. We think the Fed might be slower than that. So we do think that the Fed is going to look for what's actually occurring with inflation, the inventory buildup we've seen, the GDP number is going to be out tomorrow. We're going to see that in the U.S. From a portfolio standpoint, overall, starting in November of last year, we've generally been biasing our portfolios more towards non-U.S. assets. So moving away from the U.S. to Eurozone, EM, thinking in our minds that U.S. has reached peak growth, whereas those other parts of the world still have some way to go. So, Eurozone still is probably going to see one of the biggest GDP growth relative to the U.S. in a long time. And then EM is still dealing with, Omicron wave, vaccinations are going up across the board. So there's general shift away from place which has already seen peak growth to other areas where we're going to start seeing more peak growth. And of course, the Chinese credit impulse is likely to have a much bigger beta effect on European assets, much bigger beta effect on EM assets in aggregate. So generally shifting that around has been probably one of the biggest plays being made since November of last year, and again accelerating that in January of this year.
Right, and the call towards a little bit more exposure to EM, I'm guessing you're not fazed by the tightening cycle and perhaps a stronger dollar, perhaps.
Stronger dollar is a concern. I wouldn't say it's not a concern, but I think most CBs in EM have already been pretty aggressive in terms of raising their rates. And we think that cycle is going to continue to 2022. So, we've seen that play out in the first few weeks. And again, it's a short time, so I don't want to read too much into it. But generally, EMFX and certainly EMFX, where carry is high, has held up really well. And again, the stability of CNY, this growing demand for exports that still continues, are positive. On balance, commodities are positive for EM. Again, there are parts of EM that do get hurt by that. And then we really do like the larger markets, which is China and India for us.
That's interesting. In terms of just overall the volatility we're seeing in bonds right now, you have some in the market saying, look, maybe it's time to get on the other side of that trade of being short sovereigns and maybe even turning into more of a neutral stance when it comes to duration. How do you feel about that right now?
So one is that in aggregate in our portfolios across the board, we're definitely underweight bonds. We are being a bit balanced about duration, and the reason we're a bit balanced about duration is that specifically government assets, and I think I would probably say U.S. 10-year being the one that's most critical in terms of thinking about hedging in your portfolio. So we do like that asset only because of its hedging properties for any negative reaction that might occur in marketplaces. But in aggregate, we are underweight duration still. And in aggregate, we have still more exposure to the risk side of the equation, which is credit for us, IG, and high yields on an aggregate basis.
I'm just wondering in terms of just what the portfolio kind of strategy right now. You mentioned about being underweight bonds. There's a lot of risk now to that kind of sort of 60-40 strategy. In the face of that, do you think when it comes to China and bonds there, is that a good diversifier in the face of what we're seeing globally across sovereign markets right now?
Make the statement not only about Chinese bonds, I would make that about Chinese equities too, frankly, right? The fact that China is following this different cycle than what we see in bulk of the G7 to G10 for that matter, tells us something about that. Over time, we've seen that if you look at like 5-10-year numbers, the correlation of Chinese bonds to most of their assets is about a third of what you see with almost any other bonds in the G10 space, or frankly anything in EM. So there's a diversification argument, correlation, low correlation argument that seems to argue for Chinese bonds. There's a real yield argument, which is still, I understand obviously nominal yields have come down, but real yields are still pretty decent as you think about this from any global investor perspective. So that's the second reason why we think Chinese bonds are interesting. And then lastly, just the fact that there is such a huge underrepresentation, make up about 3% odd of investor portfolios for a market that's almost second largest in the world in bond issuance. So there are tactical factors. I think there are structural factors which indeed have us thinking about Chinese bonds more closely, and certainly a good diversifier in your portfolio. But as I said, I would also say that about Chinese equities for that matter.
And I know you're saying in terms of Asia, it perhaps is a place to take shelter as well. I'm just wondering, given just so many diverging policies when it comes to COVID, how do you find those havens in this part of the region?
I think that there's a few places that do stand to benefit from what the Fed has done. So, we like EM financials, including Asian financials for that matter. As the path of rates goes up, just as a, when we track down what's the impact a 100 basis points move in yield does to EM banks, there's an improvement of about 10% in earnings growth. So the fact that the Fed has raised means, or the Fed will be raising, means that most CBs in EM are also going to be raising their rates. So I think that's one place which in some ways you could think of as a shelter or as a haven with the rising rate environment. The other thing is that after a long time, we are encouraged by the fact that certain economies, India being notable in that category, I must sort of say really notable in that category, that they have moved away from a policy of fiscal consolidation to spending to improve or create structural reform. We saw that with bankruptcy. We're seeing that in investment that's occurring in almost every form of connection. So whether it's ports, railroads, roads, highways, so everywhere to make sure that it's easy for transporting goods, to create the structural reform that has been lacking in India for a long time. We're also encouraged by the fact that India is going through a cycle of privatization, which is really good. And I think that some of the challenges in the Chinese market with internet software companies has really enabled that the tech unicorns in India finally are able to go public at reasonable valuations and really creating more of a new economy feel within the stock markets there as well.
Right. I was just having a look at sort of your multiple on whether that's the Sensex or the Nifty, and certainly cognizant of perhaps that might be getting pulled up by the sort of old school large conglomerates there. I mean, we're still trading at either 1 or 2 sigmas above your historical mean. I'm just two-part question. You're not worried, I'm guessing, of expensive valuations? And number 2 is, when you say India, do you mean the usual names, or do you have to look at the sort of new economy stocks?
I think you look at consumer, so you can look at new economy stock, but you can also look at consumer staples. We still think there's a reasonable play occurring in the Indian banking sector. I mean, that's one place to go for really high quality banks. So I would agree with the statement that the aggregate levels of valuation are high, but you are paying for a high quality market, which still has pretty strong earnings growth. I mean, we were doing that with the US last year, right? We were paying a lot for it. There was a correction that occurred in the last few days. So it's not surprising. In a world where you're searching for good quality companies, you're going to have to pay up a bit. And if that means you go into the Indian market, I mean, we were underweight India through parts of last year, but really have been narrowing that underweight to almost an overweight position now.